Bitcoin dropped around 3.9% following the Fed decision, while Ethereum saw a deeper correction of roughly 5%. The move wasn't driven by crypto-specific news, but by macro expectations shifting again. At the same time, geopolitical signals added fuel to short-term volatility. After news that Donald Trump delayed potential military action against Iran, Bitcoin briefly rebounded above $70,000, gaining about 2%. This kind of price action shows how sensitive the market is right now. It's not just about crypto anymore, it's about global risk. Now, over to regulation, where we are seeing an important shift in classification. US regulators move toward treating major cryptocurrencies like Bitcoin, Ethereum, and XRP, and even Dogecoin as commodities rather than securities. On paper, this reduces legal uncertainty and aligns crypto more closely with existing financial frameworks. In practice, the market reaction has been muted. Why? Because there is still no comprehensive law covering the entire space. So while classification is getting clearer, the rulebook is still incomplete. Then comes one of the most important infrastructure stories of the week. Nasdaq received approval to extend into tokenized assets, including tokenized equities and potentially ETFs. This is a big step toward merging traditional finance with blockchain-based systems. Instead of trading only off-chain representations, institutions are preparing for a model where assets themselves can live on-chain. It matters because this is where real adoption happens, not in speculation, but in how assets are issued, traded, and settled. Staying on that theme, JP Morgan continues to scale its Onyx platform. Weekly transaction volumes linked to tokenized assets and digital settlements are now crossing the $2 billion mark. This is not experimental anymore. Large financial institutions are already moving real money through blockchain infrastructure, even if most users don't see it. Meanwhile, the stablecoin market is holding strong above $180 billion in total market cap. Tether and USDC remain dominant, but the bigger story is stability. Even with market volatility, stablecoins continue to function as the backbone of liquidity in crypto. They are increasingly used not just for trading, but also for payments and settlement between institutions. Now, let's look at XRP, which had a more mixed week. Despite growing regulatory clarity and ETF-related narratives, inflows into XRP-based products have slowed down. Total assets under management for XRP ETFs are sitting around $1 billion, but the number of positive inflow days in March remains limited. This shows that not every asset benefits equally from the broader institutional trend. Finally, let's touch on forecasts and sentiment. Citi revised its Bitcoin outlook, lowering its base case target to $112,000, while outlining a bearish scenario at 58. This reflects a more cautious stance, especially in the context of macro uncertainty and interest rate expectations. It's a reminder that even among major institutions, there is no single narrative right now. Overall, this week was shaped by a clear tension. Institutional capital is flowing back into crypto through ETFs, infrastructure is expanding through tokenization, and regulators are slowly clarifying the rules. At the same time, macro conditions and global events continue to drive short-term volatility. Short-term, the market feels reactive and sensitive. Long-term, the direction is becoming clearer. Crypto is integrating deeper into the global financial system, not replacing it, but merging with it. That's today's Kanga Crypto news. If you enjoyed this episode, please like, share, and subscribe to stay current with the latest news.